Welcome to the Deep Dive. We're here to cut through that daily noise and give you the insights you really need.
To be truly informed.
Exactly. Today, Tuesday, July 29th, 2025, we're diving into the U.S. equity market at midday. Now, on the surface, you might see these headline indices, flirting with record highs, lots of AI optimism swirling around.
Right, that's the story grabbing headlines.
But beneath that surface, it's a pretty compelling paradox that the market's getting pulled quite hard, actually, in very different directions. You've got severe losses in healthcare clashing with that AI hope.
And everyone's holding their breath for the Fed.
Absolutely. That Fed decision is looming large. So our mission here is to untangle these conflicting signals. We want to uncover the surprising dynamics, maybe some key risks shaping today's market.
Basically a shortcut to understand what's really driving things behind those headlines.
That's the goal. We've pulled our insights from a pretty comprehensive midday market review using a whole stack of financial reports and data, trying to get the clearest picture for you.
And it's quite the picture. A real balancing act we're seeing.
Yeah.
The market feels like it's holding its breath, grappling with a lot of different pieces of information all at once.
So less conviction, more hesitation.
Definitely less clear conviction. You can feel the hesitation as investors try to weigh genuine corporate strength against some pretty significant macroeconomic and policy uncertainties out there.
Okay, let's unpack this midday snapshot then. It really is, like you said, a tale of two cities. You've got the S&P 500, the NASDAQ 100. They're still hovering near those record highs.
Touched new ones earlier, even if briefly.
Right, but facing selling pressure now. And then standing out is the Dow Jones Industrial Average. It's the conspicuous underperformer today.
Clearly being dragged down by its healthcare components, yeah.
So what's really driving this fractured price action, especially with the S&P and NASDAQ still so close to their peaks?
Well, you've hit the core dilemma right there. This fractured price action, as our sources are calling it, it's a direct result of the market struggling with these really conflicting signals.
Okay.
On one hand, you've got broadly positive Q2 earnings. That should be supportive, fundamentally.
Must be, yeah.
But it's being powerfully counteracted by this almost palpable anxiety ahead of tomorrow's Fed decision.
Yeah.
And the complex, always shifting global trade picture.
So it leads to that lack of conviction you mentioned, the hesitation.
Exactly. Deep hesitation among investors right now.
And it's not just the headline indices, right? When you dig a bit deeper, the market's internal health, it seems a bit questionable. We're hearing this term hollow rally. On the New York Stock Exchange, declining stocks are outpacing advancing ones by nearly 2-to-1. And it's, similar on the NASDAQ. What's that telling us?
That negative market breadth. It's a classic signal of a hollow rally.
Yeah.
And it's honestly a critical insight for you watching this.
Okay.
It tells us that even if those big indices are near their highs, it's mostly just a few mega-cap tech stocks doing the heavy lifting. They're masking, broader weakness across the rest of the market.
So the structure itself is fragile.
Inherently fragile, yeah.
Yeah.
If that handful of leaders starts to falter, there isn't much broad-based support from the, let's call them rank-and-file stocks, to cushion any potential fall. That's a significant risk, not just for this afternoon, but for the coming days, too.
And kind of confirming that cautious tone, trading volume is pretty subdued today.
Yeah, noticeably lower.
Suggests a lot of people are just waiting, sitting on the sidelines before the Fed tomorrow.
That seems to be the case. And even the VIX, the fear gauge, it's ticked up a bit. Reflects that nervousness.
We can also see caution signs in other asset classes, right? Like treasuries.
Absolutely. Check in with the treasuries. Bond prices are rising, yields are falling. The benchmark 10-year treasury yield, it's dropped noticeably.
Flight to safety. Classic move.
Classic flight to safety bid. Investors seeking haven when the equity market feels uncertain.
And then there's the U.S. dollar. The greenback's rallying pretty sharply, 5-week high. What's behind that? And more importantly, what does it mean?
Okay, so the dollar strength is interesting. What's fascinating here, and maybe not fully appreciated by the market yet, is the potential challenge this stronger dollar presents.
Go on.
It's being driven by two things. First, currency traders seem to be interpreting the new U.S.-EU trade deal as, more favorable to the U.S. Second, it's the dollar's traditional safe haven status kicking in.
Okay, but the challenge?
The challenge is that a stronger dollar makes U.S. exports more expensive. And crucially, it reduces the value of foreign earnings when multinational corporations, think Merck, for example, convert those earnings back into dollars.
Ah, so potential earnings headwind down the line.
Exactly. Could be a significant headwind for Q3 guidance, future earnings reports, a potential pitfall, maybe not fully priced in right now.
And quickly, commodities.
Commodities are a mixed bag. WTI crude oil is a bit firmer, seems supported by some EU energy purchases. Gold is moderately higher, finding some support from those falling yields and just the general uncertainty.
Okay, so let's piece this together. Today isn't about one single big story dominating everything.
Not at all.
It's more like a complex dance. Three powerful forces seem to be at play. Those corporate earnings, future central bank policy, and the delicate state of global trade.
Precisely. And understanding how those three narratives are interacting, bouncing off each other, that's absolutely crucial for figuring out where the market is now and, maybe where it's headed next.
Let's start with the Q2 earnings report card then. You said it's a story of both beats and brutality.
Yeah, that's a good way to put it. Impressive beats, but also brutal punishment.
So the good news first. Overall, Q2 earnings have been, well, pretty positive, right? S&P 500 earnings look set to grow faster than expected. The beat rate is impressive.
That's the supportive backdrop, yes. Fundamentally positive on the surface.
So why all the anxiety then?
Because, and here's where it gets really interesting, Morningstar observed something key. Investors are punishing stocks that miss forecasts much more aggressively than usual this season.
How aggressively?
We're talking catastrophic drops, double-digit or near double-digit percentage declines from big names like United Health, Merck, Novo Nordisk, Whirlpool, UPS, just hammered.
Wow. So why such a harsh reaction?
Well, if you connect this to the bigger picture, this brutal reaction isn't random. It's a direct consequence of where we are.
Yeah.
Record high valuations, really elevated investor expectations.
Priced for perfection.
Exactly. The market's been largely priced for perfection. So any deviation, any miss, triggers a swift, severe repricing. There's just no room for error. The market is, frankly, mercilessly crucifying the losers right now.
Okay, switching gears to another complex dynamic, the global trade gauntlet. We're digesting that new US-EU framework.
Right, the certainty of that deal.
While also anxiously waiting for news from the US-China talks.
The hope from those talks.
So the EU deal, it avoids escalating tariffs, but there's still a new 15% US import tariff on most EU goods. And the initial relief seems to be fading.
Yeah, as investors dig into the fine print, that initial sigh of relief is fading. You're seeing the euro slump against that strong dollar we talked about.
But then contrast that with the US-China talks in Stockholm. More optimistic sentiment there.
A bit more optimistic, yes. Especially after comments from the U.S. Commerce Secretary hinting at a likely outcome being a 90-day extension of the current tariff truce.
And that's supporting tech stocks particularly.
It seems to be, yeah. Especially those tech names with significant revenue coming from China.
So this leads us to what analysts are calling a certainty versus hope paradigm playing out.
Absolutely. The EU deal is known. It's concrete. Analysts see it as a net negative reality they now have to factor in. That's the certainty drag.
Okay.
The China talks, that's the unknown future. The hope for an extension lets investors kind of postpone pricing in a worst-case scenario.
Which makes the market
Highly vulnerable. Any negative headline out of Stockholm could instantly vaporize that hope pillar. And then the market's left standing only on the negative certainty of the EU deal and that positive, but maybe fragile, earnings story.
And the third major force looming over everything, the Federal Reserve. We're kind of in a pre-Fed freeze right now.
Definitely. The Fed's two-day meeting started this morning. It's a primary reason for today's hesitation, the low volume.
The consensus seems pretty clear, though. Near unanimous expectation, the Fed keeps rates unchanged, right? 4.25% to 4.50%.
That's the baseline expectation, yes.
So if the rate decision itself isn't really the story, what are investors looking for tomorrow? What are they hanging on?
That's right. The rate itself is almost a given. The focus shifts entirely to the clues. Clues from the policy statement, clues from Chair Powell's press conference tomorrow afternoon.
What kind of clue?
Well, they'll be scrutinizing for any signs of dissension among voters. Reports suggest Fed officials might be split into maybe 3 distinct camps on the path forward.
Interesting. What else?
Forward guidance on rate cuts. It's huge. Fed funds futures are already pricing in a pretty significant chance, like 64% for a September cut. So any hints there will be key.
And the Fed's take on the economy?
Critical. especially with mixed signals lately. You had the Joel test report showing job openings falling, but then the Consumer Confidence Index actually rose. So how does the Fed weigh all that?
Which raises a big question. What's the market's biggest risk here? What if the Fed isn't as dovish, as accommodating as some people hope?
That really is the million-dollar question, isn't it?
It feels like it.
Look, the Fed's tone tomorrow, it's likely going to be the ultimate tiebreaker for short-term market direction. A clearly dovish signal could embolden investors, maybe let them look past some of those macro risks for a bit.
But if not?
But a hawkish signal, or even just a sort of neutrally cautious one, that could very well validate the bears. It could trigger a more significant market correction because investors would have to face those risks without the comfort of thinking there's an imminent Fed put coming.
Okay, let's shift to the sector dissection. Looking at the market map today, it paints a really stark picture. A truly bifurcated market, you could say.
Absolutely bifurcated. Extreme winners, extreme losers. It perfectly showcases those conflicting narratives we've been talking about.
You see that risk-off sentiment in some pockets.
Yeah, a clear defensive rotation going on.
Powerfully countered by that very specific theme-driven rally in technology all around AI.
Exactly. You've got these two strong opposing forces just pulling the market in different directions. Quite something to watch.
So information technology, it stands out as a bastion of strength, holding positive overall. But is that strength really broad-based within tech, or is it still isolated?
It seems pretty concentrated, actually, mostly in semiconductors and AI-related hardware. Your NVIDIAs, AMDs, Supermicrocomputer.
And Corning, I saw they were up huge.
Yeah, Corning, supplier of specialty glass, crucial for data centers. They're the S&P 500 single best performer today, up over 11%. This AI angle is clearly seen as a durable, multi-year secular growth story by investors.
But at the same time, showing the underlying anxiety, defensive sectors are also outperforming.
Right. Real estate, utilities, consumer staples, all up noticeably.
Classic defensive rotation.
Textbook. Investors seeking stable cash flows, maybe high dividend yields when they get nervous about future growth, and they're benefiting from those falling bond yields we mentioned.
So their strength kind of counter-signals the AI excitement.
It absolutely counter-signals the exuberance in AI. It underscores that broader market anxiety bubbling beneath the surface.
Okay, but then you look at the laggards,
Yeah.
and it's just been a catastrophic day for healthcare. The epicenter of weakness today, down significantly.
Yeah, down over 2%. It's not just a little dip either. It feels like a full-blown crisis in that sector today,
Right.
driven by just disastrous earnings and guidance cuts.
What are the main culprits?
This is where the rubber really meets the road on earnings misses. United Health Group, UNH, down nearly 6%. They slashed their 2025 profit outlook, citing an unprecedented medical cost trend environment, soaring medical costs.
And that spooks the whole sector.
Creates a powerful contagion effect, yeah. Investors immediately fear these cost pressures are industry-wide, not just a UNH problem.
Okay, who else?
Merck. MRK, down over 6%, a rare revenue miss for them, driven by a stunning 55% year-over-year drop in sales of their Gardasil vaccine, specifically in China. They've paused shipments there, announced a new $3 billion cost-cutting program. Not good.
And Novo Nordisk, that looked particularly bad.
Envio, worst day ever for the stock, plummeting over 22%, just staggering.
22%, why?
They drastically cut their 2025 forecast for Wegovy and Ozempic, their blockbuster obesity drugs.
Yeah.
They cited intense competition, presumably from Eli Lilly, and other market pressures. Just a massive reset of expectations.
Wow. What stands out to you about these huge differences between sectors, how fast the market pivots like this?
It's truly stunning to watch that speed. And beyond healthcare, you're seeing that cyclical weakness too. Industrials, consumer discretionary are struggling.
Right. UPS pulled its full-year guidance, citing macroeconomic uncertainty. That feels like a major red flag for the global economy.
It definitely raises eyebrows. And Whirlpool cutting its outlook due to weakening consumer demand and tariff impacts. That feels like a bit of a canary in the coal mine for the U.S. consumer, doesn't it?
It does. So zooming in on individual companies, it's just dramatic contrasts everywhere.
Absolutely. On the triumphant side, you've got Celcuity, CELC, soaring an unbelievable 167%.
On what?
On what some medical experts are calling practice-changing breast cancer drug trial results. Showed a huge reduction in risk. Amazing news.
Okay. Any others?
SoFi Technologies, OZEC jumped over 14%. Good earnings beat, raised guidance, showing some real resilience there. Definite bright spots in a tough market.
But then you have those casualties we just detailed: Novo Nordisk, Whirlpool, UPS, Merck, United Health. Their stories aren't just about missing a number slightly.
No, these seem to be about fundamental shifts, unexpected pressures that have led to just brutal double-digit punishments.
So moving into the afternoon session, the market feels like it's on a knife's edge.
Very much so. Technically, it's signaling overbought. Some analysts call it an overextended rally, flashing warning signs you often see before a pullback.
And key technical levels: support and resistance.
Yeah, they suggest a tough battle ahead. There are key support levels, like 6420, 6425 on the S&P 500 futures, which was the previous session's settlement, and resistance around 6445 for the S&P, 23,610 for the NASDAQ. These seem to be formidable hurdles for any recovery attempt this afternoon.
So what could potentially shift things in the session's second half? What are the catalysts?
Well, keep an eye out for any unscheduled news or, rumors coming out of those U.S.-China trade talks. That could swing sentiment quickly.
Okay.
Also, the first wave of analyst notes digesting these earnings hits, especially reacting to healthcare and industrials like UPS and Whirlpool, that could spark some follow-through moves.
And just general positioning before the Fed tomorrow.
Exactly. You'll likely see position squaring, maybe some hedging activities picking up in the final hour as people brace for Wednesday.
So strategically, how are investors likely approaching this bull versus bear case for the rest of the day?
Right. There are two main ways to frame it. The bull case focuses on those strong aggregate earnings as fundamental support. They might see today's weakness, especially outside healthcare, as an overreaction, maybe a buying opportunity, betting the Fed comes through with a dovish signal tomorrow.
And the bear case?
The bear case focuses squarely on all those red flags we've discussed. The disastrous guidance from bellwethers like UPS and UNH, the strong dollar becoming a headwind, the negative market breadth, and crucially, the high risk of a hawkish surprise from the Fed.
So based on the analysis you've seen, what's the lean?
Given the decidedly negative market breadth, that's hard to ignore. Plus the sheer severity of these negative earnings surprises and the weight of cautionary signals from key economic bellwethers. Well, the path of least resistance for the broader market, it appears to be lower for the rest of the session.
And that support level you mentioned is key.
That 6420 level on S&P 500 futures is the critical test this afternoon. If it fails to hold, if sellers push below that, it would strongly suggest the market's impressive six-day winning streak isn't just pausing. It might be decisively ending.
What a fascinating, complex set of dynamics we've uncovered today. The market really is performing this incredible balancing act. Powerful, conflicting forces everywhere.
Yeah, you've got that AI-fueled resilience in tech, but then these catastrophic collapses in healthcare.
Yeah.
And the whole market just seems to be holding its collective breath for the Fed tomorrow.
It's a vivid reminder of how quickly sentiment can turn, isn't it? Especially when expectations are just so incredibly high, like you said, priced for perfection.
It really is. One misstep gets punished severely.
And that leaves us, and you, with a provocative thought to chew on. What does today's brutal punishment for earnings misses, especially in this kind of market, priced so high, experiencing that hollow rally, what does it tell us about the sustainability of these record highs going forward?
A very good question.
And maybe, how will the market react when the hope tied to future events, like that China trade deal extension, eventually meets the reality of current economic headwinds, like the strong dollar or slowing demand?
It certainly leaves us with a lot to ponder as we head towards tomorrow's pivotal Fed decision. Definitely one to watch closely.
Indeed. Thank you for joining us on this deep dive. We'll catch you next time.